For Chapter 2, you process business transactions, and we're going to go through these, show the T accounts, and then after that work with financial statements. The first one is Casey Spade, owner, invested $100,750 cash in the company. We're dealing with the journal entries, so let's look at what accounts are being affected. We have the owner invested cash. So what that means is we now have cash that we didn't have before. We will debit cash because assets, which is cash, increase on the debit side. The owner invested, so the owner is going to get credit for that. We will credit the capital account, K Spade Capital, $100,750. Looking at the T accounts, cash will have a debit. This is where you would post it. You would post it into the account. And then you would record the credit side, which is the capital. So two things are going on here. One, we're recording in the GL or general ledger. And then from there, we post to the general journal, which would be similar to the T accounts. The second transaction is the company purchased office supplies for $1,250. They purchased supplies. So now they have supplies that they didn't have before, and they paid cash. So those are the two accounts affected, supplies and cash. Supplies increased, so that is our debit. Cash decreased, so that is our credit. We still keep everything in balance because we have a debit and a credit of the same amount in the asset section. Oh, my necklace just fell. Okay, so okay. And there's the T account for it. Now you'll see with cash, it has transaction A and transaction B in it. You keep a running total of what's in the account. So with each T account that we have in each chapter, and each transaction, we're going to add to it. Okay, transaction C. The company purchased $10,050 of office equipment on credit. Okay, let's look at what's affected. We have office equipment and it was on credit. If it's on credit, that is accounts payable. Office equipment is an asset. We now have it, so that's a debit. We owe $10,050, and so that is our credit. Accounts payable is a liability, and as you can see down here, liabilities increase on the credit side. We would then post, we have a debit of office equipment, $10,050, and then post the credit of $10,050 to accounts payable. Transaction D. The company received $15,500 cash as fees for services provided to a customer. Received cash, fees. Those are the two accounts. Fees for service is the revenue account, and then we know cash is an asset. We received the cash, so that's the debit of $15,500. And then the fees earned is our credit, which is our revenue account. Revenues are on the right-hand side of the T account, or the right-hand side of the accounting equation, and the right-hand side increases it. We increased our assets, and we increased our revenue, our equity. We will add to the two transactions we already have in cash, and then we'll post also to the revenue. This is the first time we're posting to the revenue, so it's the only one that I have in here so far. E, the company paid $10,050 cash to settle the payable for the office equipment purchased in transaction C. So we already did transaction C. That's where we purchased it on account. Now we're paying it. We will debit accounts payable $10.50 and credit cash $10.50. And I want to explain that by looking at the T accounts. You'll see in the original transaction, in transaction C, we credited the account $10.50. Well, now we're paying it. So it's natural that you want to do the opposite to make it zero. By crediting accounts payable, we're recognizing that we owe the $10,000. So when we pay it, it's going to be on the opposite side to decrease it, which will give us a balance of zero now that we've paid it off. When you charge, you credit accounts payable. When you make a payment, you debit accounts payable. And then we credit cash because we are paying it, we are writing a check. Okay, transaction F. The company billed a customer $2,700 as fees for services provided. Okay, the company billed a customer, so billed, tells us it's accounts receivable, just showed up, and fees, that is revenue. So they earned revenue, they provided the consulting services, and then they bill the customer $2,700 for it. So we will debit accounts receivable. Accounts receivable is an asset. That is the account that we put all of the money that is due to us in. We will receive the money from the account later, accounts receivable. And then it is fees for services provided, which is fees earned, and that is a credit. Fees earned is part of equity, it's our revenue, and that increases on the credit side. We increased our revenue. Okay, this is the first time we're using accounts receivable, so here it shows as just a debit of $2,700 for this transaction. And then under fees earned, this is our second transaction that we have. So we have transaction D, and now we have transaction F for $2,700. Transaction G, the company paid $1,225 cash for monthly rent. The key words here is cash and rent. They paid cash for rent. We will increase our rent expense by $1,225. You will only ever debit an expense account. We paid cash, so cash decreased. That's a credit. We now have 5 transactions sitting in our cash account, 2 debits and 3 credits. Transaction H. The company collected $1,225 cash as partial payment for the accounts receivable created in transaction F. The key words are cash and accounts receivable. So they collected cash from an accounts receivable. We collected cash, so we now have the cash. That's a debit to increase cash. Accounts receivable is also an asset like cash, but this time this one decreased. Basically what we did is we moved the money from accounts receivable into cash. So we will credit accounts receivable and debit cash. In transaction H, you'll see the increase of cash and then the decrease in accounts receivable. 1 debit and 1 credit. And then the last one is I. Casey Spade withdrew $10,000 cash from the company for personal use. This is her draw. As an owner, she'll do this every month instead of getting a regular paycheck. You will debit the withdrawal account, which coincides with the capital account that she has. The capital account is what she has invested in the company. The withdrawal account is what she takes out of the company. And then they will write a check to her, so we'll credit cash $10,000. A debit for the withdrawal, and then add the credit of $10,000 to cash. Okay, these are all of the T accounts put together. The longest one is going to be cash, and you want to get the balance of each one because this is the only way to find out how much we have in each account is by posting to the T accounts, I guess you could say. Add up all your debits, add up all your credits, and then subtract the two, and then that tells you what your balance is in each account. The side with a higher balance, when you add each separately, is the side that your actual balance will go under. Some accounts only have one transaction, but you still want to draw a line and then write balance and the balance of each account, just to keep it consistent with everything. In this one, we're going to work with an income statement, and you need to make sure that you do the financial statements in a certain order. Income statements have to be first because we need our net income, which is calculated in an income statement, to transfer to the statement of owner's equity. The statement of owner's equity is going to give you the new amount in the capital account, and that you need for your balance sheet. Next, we're going to work with an income statement, which is the first of the three financial statements we're going to work with. Here we have a list of the accounts and their balances. And an income statement starts with the 3-row heading, who, what, when. Who is the name of the company, Help Today. What is the name of the financial statement? This one's the income statement. And when is the month or time period that it is for, which is for month ended August 31st. An income statement has revenue and expenses. And we're going to start with the revenues first. Assets are reported on the balance sheet, not the income statement, so we're going to take away all of the assets. Liabilities are also reported on the balance sheet, so we're going to take those away. And the capital is reported on the statement of owner's equity, so we don't need that. The withdrawals are on the statement of owner's equity, so we don't need that. What's left are the revenues and expenses. You will start with revenues in a colon, go down to the next line, indent, and write the name of the revenue account. This one is consulting fees earned. The left-hand side of the column is the column that you use to add anything up. Your totals go straight to the right-hand side. Next, we're going to list our expenses. We have 4 of them: rent, salary, telephone, and miscellaneous. These happen to be listed in order from largest to smallest. You don't have to do it that way, but you can if you'd like. Those are listed on the left-hand side because we need to add them up. The total equals $16,530. Since that is a total, it goes on the right-hand side. Don't forget to write expenses with a colon and then indent each expense. Take your revenue and subtract it from your total expenses, and you get your net income. You can see that underneath the net income of $10,470 is a double underline. You always want to double underline your grand total. Another thing that you want to make sure that you do when you work with financial statements is you put the dollar signs in the appropriate places. Dollar signs will go in the first The first time it is listed, a number is listed in a column, and then your grand total at the end. This $10,470 is going to be used in the statement of owner's equity. That's why you have to do your income statement before you do your statement of owner's equity. Okay, now we're going to work with the statement of owner's equity, which is what you do after you do your income statement. Statement of owner's equity, same thing. You have your 3-row heading, who, what, when. And you start with the capital at the beginning of the month. And you end with the capital at the end of the month. What you ended July with, you're going to start August with. So you can either write C. Camry Capital July 31st or C. Camry Capital August 1st. It's going to be the same amount. It's just preference, really. Okay. The next thing is you want to add certain things that affect the capital account. Any investment by the owner is going to be added to the capital account. Any net income you have is going to be added to the capital account. There are also a couple of things that you withdraw from the capital, and that is the withdrawal from the owner. And then if you have a net loss instead of a net income. Once you do this adding and subtracting, you will get to your new capital total at the end of the month, August 31st. Okay, so let's see what we have. This is a new company, so we started off August with 0. The investment by the owner was $102,000. It states it right here. The owner invested $102,000 cash. The owner withdrew $6,000 from the company. And then we have to figure out if there's a net income or a net loss. That comes from the income statement, which is that $10,470 that we just finished. So we're going to add that $10,470. It's a net income, so we add it. If you have a net income, you don't also have a net loss. So the only thing that we're subtracting in this problem is the $6,000. Since we're adding two things, we'll go ahead and add them together and get a subtotal, and then subtract that from the withdrawals. So we will take the 112, subtract the 6,000, and we come up with our new capital balance of $106,740. I'm sorry, 470. And this amount, what am I doing? This amount, well, I'm sorry. Let me go back. This amount we are going to carry forward to our balance sheet, which is the last financial statement we're going to look at right now. Now we're going to look at the balance sheet. The balance sheet has the same thing, who, what, when, but this time the when is going to look a little different. When you're looking at the income statement and the statement of owner's equity, it's going to say month ended August 31st because you're looking at a time period. You're looking at what happened from August 1st to August 31st. When you're dealing with the balance sheet, you're taking a snapshot on August 31st and what are the balances in those accounts on August 31st. Therefore, it's not going to say month ended, it's going to say just August 31st. The reason why it's called the balance sheet is because we're looking at the accounting equation that we need to keep in balance. And basically with the balance sheet, we are proving the balance of the accounting equation. So the bottom of the balance sheet is going to have total assets on the left and then liabilities and equity on the right. Assets go first, then liabilities, then equity. Remember, the assets are listed in order of liquidity. Here are the 5 assets we're looking at, and they are in the order that they need to be in. List all 5 of them and add them up, and double underline. Don't forget, the first time that you list a number in a column, it gets a $sign, and your grand total also gets a $sign. Next, on the right-hand side, we're going to list what's in the right-hand side of the accounting equation, which are liabilities. And we have 1. We have accounts payable. Accounts payable is $10,500. And then we want to list our owner's capital account. Now you can see here that the capital account listed is 0. That's not the amount that we use. We just finished going over the statement of owner's equity, and that is the total, the new capital amount that we use for this problem. Not the one listed, because this is the one before we've done the statement of owner's equity. Add your liabilities to your equity, and we get $116,970, and that should equal your total assets. Remember, double underline the totals at the bottom. $signs the first time a number is listed in a column, and $signs on your grand total. Assets are listed in order of liquidity, then your liabilities and owner's equity on the right. Remember, you do not use the capital amount that's listed here. You use the total that you get from the statement of owner's equity.